Well, hello everyone. I hope your Monday so far has been a good one. It's mine hasn't been bad. It's been a little bit frustrating with something I was trying to get updated on my work computer, but these things happen. I just kind of moved on. Hey, Joe, thank you very, very much for your email talking about, and I let Rich know he's going to need to take me for the diagnostic exam, diagnostic testing thing. I did not realize I would need someone to drive me. So thank you so very much for that because that would have been really a whole big bucket of suck. Hey, Carrie, how are you doing? Today we are going to be talking about it's so hard for me to call it body. I mean, let's face it. We all know it's still Beachbody, and they're trying to make it look like it's no longer Beachbody by changing the name, yada yada yada. No longer calling them coaches; they're now partners. It's still the same. It really is. Yeah, work computers are the worst. I mean, trying to get this. Literally, I was told that somebody like I would have to go to a site. There's no sites near me, or that somebody would come to my house. Again, there's no sites near me. So is somebody going to fly in from another state to come and resolve this problem? I don't think so. I just kind of gave up and I just moved on. It's like, okay, so I'm not going to be able to update Camtasia. Got it. Okay. Uh, yeah, Joe, I really did appreciate that. You have no idea how much. And my first, I guess, diagnostic with the whatever the heck it's called, the block thing is going to be on the 30th. So looking forward to hoping maybe that does kind of point to the right nerve they found to be able to take care of this because living in this pain all the time sucks majorly. Hey, Chelsea, how are you doing? So over the weekend, I have various different Google alerts, and one of them is about Beachbody. And I came across the quarter four of 2022 earnings call transcript. And I just thought, isn't this interesting? I mean, maybe I'm weird that I find these things. Thank you, medial branch block. Yes. And Carrie, did you have success with that? Hello. I'm not going to say your name right. Mamu Chan from sunny South Africa. I hope you are having a wonderful day. Hey, Jeanette, how are you doing? So let me first share something else that I found. But I thought it'd be interesting to read what was said in this quarterly report sort of a thing. Because again, I find it really super interesting. But I also came across this, and it's basically like, should you, and oh, I meant to show you guys something else first. Well, I will just take this back and go to the thing that I wanted to share first. That's how we'll do this now. Can I find it? Is it here? No, it's not there. Okay, this is it. So I found this on Google Finance, and the lowest price of the Beachbody stock has been 50 cents. So it looks like today that it closed at 53 cents. So we're picking up some steam. And please, please realize I am being horrifically facetious in that. But you can really see that it's been, pretty flat along here. This is, let me see. Let's look at it for 6 months. What's it been like? Not so great. 1 year. And it's just been going downhill, going downhill, downhill, downhill. I mean, they kind of like had a slump and then bounced back, but then, it just hasn't been performing well. And, I'm going to say one of the reasons why I think that they're not performing well is because people in anti-MLM, myself included, have spoken out about Beachbody. And, a lot of people saying what their experience was like as not being, all that great, and that you really can't make money through this opportunity. That probably has hit them. And I believe there's also been a class action suit. My memory is a bit shaky on that, so I could be wrong. So if you know, let me know, because I honestly can't recall. Chalupa, where do you think you're going? Are you gonna jump down now? You need to go down the stairs, son. That's what you need to do, is go down the stairs. I have stairs at the end of my bed to help the babies get up and down. Okay, you want to go under the covers? Okay, Chalupa now wants to go under the covers because I'm talking about Beachbody. And I don't blame him. There you go, baby. There you go. Okay, he's all comfy cozy now. Thank you. I'm glad you have some thumbs up for my back. I'm hoping it will be better. And it's also been my neck too. And Joe, you have issues with your neck too, I believe. So yeah, that's a whole lot of fun. But I find it really interesting just kind of looking at this. And I remember when the whole stock thing came out and coaches were like so excited. They were thinking, oh my God, we're so legit. We're like on the New York Stock Exchange and like everything. And like, look how fancy we are. Well, and do you think those people who initially got stock kept it? Or do you think they dumped it? My guess is once you get out of Beachbody, you're like, screw this, and are dumping stock. I could be completely wrong, but I would not see any reason to hold on to it when you have concluded like this is not a good option for me to make money. And I'm kind of wondering what some of these higher ranking coaches that have been around for a long time, like Bonnie Engel and Lindsay Matway and Shay Stanford, what's his name? Oh, I can't think. Scotty Hobbs, people that have been around for years, 10 or more years, it's like, what are they doing? Are they holding on to their stock? Are they gifting their stock? Because I believe I read somewhere that you can like give stock as an incentive. So is this now part of the incentive package for coaches that, I don't know, maybe make it to Diamond? Do they get some stock for free? I mean, you might as well just give them, a cup with nothing in it, because literally this stock is not really doing very well. And I don't foresee it doing any better in the future. Jeanette says, I'm finishing up. Sure thing. I paid for it, yet I haven't renewed. Good. I'm glad you haven't renewed, because I really don't think it's worth being attached to any of this. And I'm still going to plug for my girl. Oh, what is her name? She does the walk for home. Leslie Sansom, Leslie something another. She's on YouTube. She has some stuff, but she also has another program too. And as soon as I am able to actually standing up, meaning like I'm not in pain while doing it, I'm definitely going to be doing some of her at-home workouts, because I like that I can just do it in the living room, no matter rain or shine, or if it's cold or if it's hot. And if you don't know, in Houston, it gets, super hot, especially August. But I think we're supposed to have a hotter than normal spring. So I'm not looking forward to that. So I thought that was interesting. And then let me see what's the next thing that I started to share with you guys. Then I was like, oops, wrong thing. Okay, it's this. And I literally just came across this. I was like, huh, interesting. And what did I think? Let me see. So I was looking at this volatility out of control. What do the details say? I mean, look at this. It's just like stock volatility depicts how high the prices fluctuate around the mean or its average price. In other words, it is a statistical measure of the distribution of Beachbody daily returns, and it is calculated using variance and standard deviation. We also use Beachbody's beta, its sensitivity to the market, as well as its odds of financial distress, to provide a more practical estimation of Beachbody volatility. So I would just say it's pretty high. Which, I am not someone in the finance thing. So it's like I can't really speak to this stuff like with any type of authority, but just looking at this overall, and I found this hype condition overhyped. It made me think of Beachbody in general, or body, whatever you want to call it. I really don't care. It is like overly hyped. Now, I don't know what odds of distress mean or anything. I'm sorry, I just don't. Economic sensitivity, hyperactivity response to market trends. Okay, but there was something that I think I found down here. Okay, it was this stuff. So Beachbody trading alerts and improvement suggestions. Beachbody generated a negative expected return over the last 90 days. Beachbody has high historical volatility and very poor performance. Ding, ding, ding. That would be something to make me go, wow, this is not a good investment. Beachbody has some characteristics of a very speculative penny stock. The company currently holds 39.73 million in liabilities with debt to equity ratio of 0.02, which may suggest the company is not taking enough advantage from borrowing. Beachbody has a current ratio of 0.92, indicating that it has a negative working capital and may not be able to pay financial obligations when due. Now, reading that really struck me, because if you cannot pay for things that you need to pay for, that's a huge problem. And I think when we look at what was said in this Q4 financials, I think Carl is trying to be a cheerleader, because, I mean, isn't that really his job? Carl Daikler, aka cheerleader for Beachbody, you know. Let's see where. Debt can assist Beachbody until it has trouble settling it off, either with new capital. Where is new capital going to come from? Are they going to get investors interested in this? Because it's not doing very well. I mean, maybe somebody who is going to speculate and like, oh, I think they can come back. I mean, I guess maybe some of the capital could be from, and I mean, it would have to be a lot of people coming in as coaches. I mean, I'm sorry, partners. And I just don't see that as being something very plausible, especially today. Somebody again sent me screenshots of how many people received recognition in the National Wake Up Call. And this week, if memory serves, because I've done other things, it was 10 people total. 10 people total. Last week, it was 7. How is that showing any kind of growth? And a couple of years ago, there were tons of people receiving recognition because they were ranking up. And one of the things that I think is really hurting people is this preferred customer program, which we will look at that too, because that has always just really irritated me, because I think it's really just designed so that the long-standing coaches like the Lindsay Matways and stuff, that they could basically snag other people's customers or possibly coaches, or coach if they have them or something. I don't think it's a way for the people just signing up to be able to maintain their rank. They have eliminated lifetime ranks. Okay, so debt in this case can be an excellent and much better tool for Beachbody to invest in growth at high rates of return. When we think about Beachbody's use of debt, we should always consider it together with cash and equity. The entity reported the previous year's revenue of $692.2 million. Net loss for the year was $194.19 million, with profit before overhead, payroll, taxes, and interest of $369.57 million. Beachbody currently holds about $64.13 million in cash, with $47.14 million of positive cash flow from operations. This results in cash per share CPS ratio of 0.21. roughly, and this is also something that I found interesting, roughly 15% of Beachbody shares are held by company insiders. And this is what we're going to look at is the Q4 2022 earnings call transcript. But when I saw this, when are held by insiders, it made me think about the partners, the coaches, or whatever, you know. If you have to go to COD, and is that cash on demand from vendors, they are screwed, is what Joe says. And so let me get over to that whole thing of preferred customers. Give me a moment. I'm going to have to like track this down of where the heck did I put it? I think it's there. Yeah. Okay. All right. So this was rolled out. Oh, over a year ago. The exact time frame. I did a video on it when it happened, and I don't remember when that was, and I didn't look it up. So now you have customer, preferred customer, and coach. And there are some crossovers between preferred customer and coach. So you're thinking like, well, you know, what's really the only difference? The only real difference is with as a coach, you can, well, a partner, but they have coach here. And this is still FAQbeachbody.com. So they're never going to really get rid of that whole Beachbody thing. And it is the Beachbody company overall. That's the general umbrella. Everything falls under. So hello, it's still Beachbody. So overall, coaches can get other people to join them. So that's that. And okay, I need to take a sip of my drink. With the launch of preferred customers, Body will perform a semi-annual review to identify those coaches who would be more appropriately classified as preferred customers. Now, mind you, this is not somebody coming in and saying, I want to be a preferred customer. This is someone who signed up thinking, you know, I can make some money while working out and getting other people to sign up and live a healthy life with me. Yay, watch me go. And then they probably realize this is a serious struggle. And most people are ignoring me or running from me. And those who actually say yes probably feel like they're being, you know, wrestled, you know, arm wrestled or something and strong armed to actually buy something. And meanwhile, now these days, you don't get a challenge pack like you used to for like about $150. No, it's over $200 now that you're asking people to shill out. And that's a lot. So Jeanette says discount coach was renamed as preferred customer. There was never formally anything called a discount coach. That was something internally that the coaches came up with, was the idea of a discount coach. But I don't think that was ever a formal thing. I could be wrong, but that's just what comes to my mind. So to remain a coach, you have to do one of the following activities every 6 months from the date of your enrollment. You have to have one enrollment of somebody who's like, oh, yes, I want to be a preferred customer. Or somebody who's just like, oh, yes, I want to be part of your team and we're going to rock it, girl, because we're going to get more people to join and we're going to be making the money with this. Or you have to have one sale to a customer or preferred customer that generates personal volume. Now, personal volume, that is attached to each and every single product, as far as I know. Maybe something has changed, but since the last time I looked, every product has volume points attached to it. Now, they don't say that you need to have a particular number of volume points. So maybe, you know, you would be able to get somebody to be like, okay, I'll be a preferred customer. And I think for a preferred customer, you still have to pay like $15, $16 each month just to be a preferred customer so that you can get a 25% discount, which really doesn't sound like a good bargain to me, just doesn't. And so now you're running around making sure that this happens once every 6 months so that you can, if you made it to, let's say, Emerald, you want to stay there. But if you only have one coach, you have dropped rank, but you need to then make sure that you have at least one sale to a preferred customer or to a customer if you only have one coach. And maybe you will, maybe you won't. I know I've seen people post in my comments that basically they got screwed with this whole preferred customer thing. And that's the thing that I always thought would happen, is that you're not choosing yourself. Like, okay, I just want to be a preferred customer. No, the company is deciding you're no longer allowed to sell anything. You're just going to be a preferred customer. So that means that when you were, let's just say that you did get to Emerald, and when you get to Emerald, you do get kind of like, I think it's with you get Success Club. Again, it's been a minute. Then you get some people that like kind of basically goes to your email list. So then those people would roll up to the coach above you. So whoever you signed up with. And that kind of sucks because then you have to start all over from square one, since you're now a preferred customer and you're like, well, I really want to do this thing and I want to make money. Now you have got to sign up 2 coaches to become Emerald again. You just go back to square one over and over and over again. And how fair is that? The company just makes the decision, you're just not going to be a coach. We're just saying all you are is a preferred customer. And you could be working your butt off trying to do all the things, but you're not being rewarded whatsoever. And I just find that to be very sleazy. Maybe it's just me. I don't know. Okay, where is now? Let me see. Is it this? Hang on. I got to look and see what this looks like before I pull it up to make sure I'm pulling up the right thing. Definitely not that. Oh, and those of you who do watch me for the on passive stuff that I've been covering, I went down a rabbit hole today and I found some stuff on this guy, Peter Suhr. I never say his name right. And it was just very interesting. Just very, very interesting. And so I'll probably be streaming about that relatively soon. Okay. So it's here. Okay. All right. So this is the transcript, and it was published March 17th of 2023. All right. Operator. Good afternoon, ladies and gentlemen. Welcome to the Beachbody Company's 4th quarter and full year 2022 earnings call. At this time, all participants are in listen-only mode. Following the presentation, we will conduct a question and answer session. Instructions will be provided at that time for you to queue up for questions. I would like to remind everyone that this conference call is being recorded. And I will now turn over the call to your host, Bruce Williams, Managing Director of ICR Investor Relations. Please go ahead. Bruce. Welcome, everyone, and thank you for joining us for our 4th quarter and full year 2022 earnings call. With me on the call today are Carl Daikler, co-founder, chairman, and chief executive officer of the Beachbody Company, and Mark Sudan, chief financial officer. Following Carl and Mark's prepared remarks, we'll open the call up for questions. Before we get started, I would like to remind you of the company's safe harbor language. The statements contained in this conference call, which are not historical facts, but may be deemed to constitute forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. Actual future results may differ materially from those suggested in such statements due to a number of risks and uncertainties, all of which are described in the company's filings with the SEC, which includes today's press release. Today's call will include references to the non-GAAP financial measures. I'm not sure what that stands for, such as adjusted EBITDA, which I am sorry, I don't know what that stands for, but I will look those up real quick because I want to know what that stands for. So we'll just do this together. Okay. It's okay. The GAAP earnings is generally accepted accounting principles. Okay. That's good to know. And I'll probably forget that, but you now know what that is. I at least have told you once. And if you're like me, you'll probably promptly forget it. But you can also look it up. Okay. All right. EBITDA is short for earnings before interest, taxes, depreciation, and amortization. I certainly will not remember any of that, Okay, so now we have that underway. A reconciliation of these non-GAAP financial measures to the most comparable GAAP financial measures is available within the earnings release, which can be found on our website. Now I'd like to turn the call over to Carl. Enter Carl Daikler. Carl Daikler. Thank you, Bruce, and good afternoon, everyone. Okay, first, let's get caught up. On our last earnings call, we presented our expectations for the fourth quarter and our plan to continue bringing costs in line with the dynamic environment. Okay, that's one way to say things have been shaky. All while we pursue our significant strategic innovation plans for 2023. I'm pleased to say we delivered fourth quarter revenue in line with our expectations and adjusted EBITDA that was well ahead of our guidance. 2022 was a demanding year, and I'm proud of what our team achieved despite the challenging economic backdrop and the headwinds faced by our industry. I would say some of those headwinds are definitely overall MLMs being called out by anti-MLM. I mean, maybe it's just me, but I would just certainly think that had to do with it. And in terms of the challenging economic backdrop, I mean, we all know prices of everything has been going up. People have lost jobs. There's been, layoffs in the technological sector. So, there's different things going on that do impact companies. But more than anything, I really think a lot of this has to do with Beachbody is no longer that shining fitness star it once was. But we met or exceeded guidance in all 4 quarters of 2022. Meanwhile, everything has declined. And we executed on our one brand strategy that we announced exactly a year ago during our 2021 quarter 4 earnings call. And that is the whole body thing. We're like, we're all going to be body now. Actually, to put this all in perspective, let me step through the highlights of what we said we would do and the actions we executed in 2022. As you might remember, we made the decision to consolidate the business into one platform to focus capital allocation and centralize all our technology, marketing, and content investment. In July, we initiated the migration of the OpenFit platform content to subscribers into the Beachbody On Demand platform and began engineering the consolidation of Beachbody On Demand subscription together with our premium body subscription to create one simplified and pricey, but extremely compelling offer. I'm proud to report that work was completed on time and under budget just a couple of weeks ago. And now we're launching the world's first complete health esteem platform under the body brand. Okay, that is just going to always irk me, the health esteem platform. Okay, meanwhile, I mean, so many people have done videos about their eating programs and starvation diet type things and it not being so healthy. But okay, Carl, with the greatest digital fitness catalog in the business and its stream of compelling new content every month, I find it interesting that the man keeps saying compelling. What is making their content compelling? I'm not really sure. Okay, thank you, Rachel. That's what I thought. Discount coach was not a corporate sanctioned term. It was purely made up by the distributors. That's what I thought. That's what I remembered. Thank you. And it's like, okay, so you've now put everything under one roof, so to speak. But what would really drive people to go there, especially when people overall, in general, I would say, are less trusting of multi-level marketing companies. At least the word is out far more than it has been in the previous decades because of grassroots efforts of people coming out and pointing to the problems with the industry. A full nutrition section with two incredibly popular eating programs and over 1,000 healthy recipes because you can't get healthy recipes anywhere else, plus a brand new positive mindset channel to help our subscribers feel great about themselves in all shapes and sizes. Now, this whole positive thinking bullshit, we just don't need any more of it. There's plenty of stuff out there. If you really want to get into positive thinking, you don't need body to do that. There's plenty of things out there. There's plenty of things out there on YouTube for free, as well as workout programs as well. You don't need body. More on what that means in a minute. But fundamental to all this activity was a thorough approach to taking costs out of the business and formulating a clear roadmap to profitability by focusing on our customers' biggest problems and their wants and needs. We completed the process of aligning headcount, technology, and production spend with the business plan and reduced our nutrition SKUs and key bundle configurations known as total solutions packs from 190 variations down to 5. And these are the things that cost over $200, which before you could get something for like $150. You could get Beachbody on demand for $99 as a coach for the year. And now that has gone away. So they've basically limited choice and have made it more expensive for people to do. Yay! That sounds like such a good plan to me. Am I the only one that finds that problematic? Maybe so, but it seems really kind of like, what are you really trying to do here? Are you just trying to, I don't know, suck out of the wallets of people one last time before this thing finally does go away? I mean, do you guys think that Beachbody is going to die and go away? And maybe it will, because, I don't see Carl just like not being in the MLM business because, he's done it before. And I did an entire video on his background, which he was originally with a company called Guthrie Ranker, which Guthrie Ranker did a whole bunch of infomercials. So if you ever wondered why Beachbody had so many damn infomercials, it's because of Carl's background. Your laptop is starting to smell the bullshit. Yeah, Joe, I thought it would. Okay. Further simplifying and streamlining the business in 2022, we improved EBITDA and CapEx by $125 million. That's ahead of the $110 million target we promised earlier this year. We're confident that we're on a path to consistent adjustment EBITDA profitability by Q4 of 2023. And with our 2022 debt raised, We don't foresee any additional need for capital. The business implications of these changes are compelling. There he goes using compelling again. This is the third time the man has used compelling. This consolidation simplified what our network of body partners, Beachbody coaches, offer. We used to call them Team Beachbody coaches. Now we call them partners. Boy, doesn't that sound better? You're now a partner. It kind of reminds me of founders, like you actually think that you're part of this. You're not actually a partner in Beachbody, in body. You're still just an independent contractor. Let's be real. This consolidation drastically simplified the array of options body partners offer to their prospects. Isn't that interesting that he uses the word prospect? I think it is really strange. What the L says, no capital, no growth. Okay. So now the field can spend less time training their teams and focus more on helping people engage with the platform. Oh, good golly, Miss Molly. Okay, so when they're talking about the field, they mean all the distributors, all the Beachbody coaches, all the body partners. And I guess they're speaking really about coaches with massive teams. You don't need to train people anymore. Just focus on people engaging with the platform. So you mean like doing the workouts, doing the, I guess, recipes, that kind of stuff. That's what they need to do instead of focusing on training their teams. Don't you think maybe they do need some training in how to do this or something? Maybe the training that you provide corporately for new partners instead of coaches is pathetic, because it actually is, because you don't teach anything on selling. And let's be honest here. The primary thing you do as a Beachbody partner, a body partner or Beachbody coach, is you sell. And you need to be able to sell a hell of a lot. And most people are not naturally gifted as salespeople. And that's something that's predominant throughout the MLM industry. The bottom line is you're selling people on the dream, and you're selling them to join you on your team so you can make money because you now have a downline. That's the thing right there. Okay, so engaging with the platform. That dramatically increases their income opportunity. How does that increase their income opportunity unless you're talking about selling one of these 5 bundles to people for over $200, and then they would earn 25% of that, so they'd get maybe $50, which should in turn attract more people to sign up to the body partner. See, that's what they're wanting, more people to actually be coaches. It's right there. It's all about recruiting. That's absolutely what he's saying right there. Is our goal is for people to recruit more people. On the last call, we also introduced our plan to reposition our company and brand to fill a major void in the industry. What void is that, pray tell? We spent 2022 rethinking how to best serve. Oh, good Lord. Such an MLM thing, to serve people. Oh my gosh, gag. The significant TAM of people. What is TAM? TAM meaning? Let's see. Total available market. Okay. All right. The significant total available market of people who've been left behind by the legacy fitness and diet industry. So when he says legacy fitness and diet industry, is he talking about Beachbody being their legacy and they're trying to now distance themselves from that? Because that's what it seems like to me. We're doing what category leaders do. We're expanding the size of the addressable market so that we can get more people to become body partners or Beachbody coaches or whatever. Basically, we just want to recruit more people into this MLM. We're doing okay, I already said that. We're expanding the size of the addressable market, and to that end, we launched the health esteem category. Let me elaborate on this vision before I turn it over to Mark, so you have context of this expansion as you get into the specific KPIs for the quarter. I think you'll see we're extremely well positioned for growth because what we've learned really since the pandemic, but especially last year, is the majority of consumers are rejecting the premise of a legacy fitness and nutrition business that runs a playbook convincing prospects they aren't good enough until they lose the weight and get the six pack. So, really, that's what they're doing. They're saying, all the things that we used to say in Beachbody, yeah, we're not saying that anymore. Um, we're going to try something else. Okay, so I'm sorry, I just lost my. Okay, here we are. In fact, we discovered this gap when we had two surprises last year. Of the programs launched, two of them surpassed our expectations. 4-week gut protocol and fire and flow, both which focus on how you feel while you do the programs versus focusing on the results that you achieve at the end. It became clear to us that our transformation model of P90X and Insanity, P90X was the very first one, and that was by Tony Horton, and Insanity, which is a Shaun T program, could be significantly complemented by an ongoing plan that focuses on how people feel today so they stay engaged in the process and appreciate their sense of well-being along the way. This represents a significant business opportunity for us because the data is clear that the legacy industry is failing at this. Okay, basically, Beachbody failed at that. So we are revamping and we are going to tell people that we're all about how they feel, not about how they look. Overall, happiness has declined over the last 49 years, while obesity rates and lifestyle diseases have increased. Now, if I remember correctly, one of the things that Carl always harped on was the obesity and basically to transform people who are in the obese category into a healthier weight, living a healthier, more fulfilling life. It was something like that. There are 150 million adults in the US that are overweight or obese. That's 74% of adults, and that number is climbing. The legacy industry has concentrated its effort on convincing prospects of their faults to motivate them to buy that treadmill or join that gym. And it's primarily retraining the same cohort of people who move from one solution to the next over and over, trying to find happiness. Once we saw this gap in the market, we were quick to organize and expand the platform to serve this new category of health esteem. That is what's been missing from the model, a comprehensive solution that fits with real life, that delivers happiness on day one, not just physical results at the end of the program. Meanwhile, they have been focusing on that for over 10 years. What most adults look like for today is the support to reduce anxiety in their lives, to feel better, and to improve their self esteem. You don't need an MLM to do that. People don't want to be deprived of the freedom of take days off from training or enjoy that food they love. Bread, for instance. Like, when did food become enemy number one? Well, if you look at it in all of your eating programs, Carl, that might have been where people got the idea that food was an enemy. In fact, as we surfaced this new category, we discovered a bold way to help people get healthy while they still enjoy the foods they love. We actually encourage people to eat more dessert. And that's a whole new category we're moving into with the existing products. Back in 1998, when we founded Beachbody, we defined the home fitness category with our content. Then we saw a dramatic period of growth when we created the category of superfood health shakes, Shakeology. And we're now taking everything we learned from the last 2 decades and our observations since the pandemic and expanding the market by opening it to this holistic new category of health esteem. Goodness. Sorry, have to take a sip. I should probably be taking a shot of vodka or something, but I'm not. You'll see this materialize in five significant ways. First, as I said, we consolidated our subscription tiers of the body of BOD, Beachbody on Demand, and Body into one simplified, complete bundle. We call it Body for an annual subscription price of $179 or around $15 a month for access to our library of 120 fitness programs or over 8,500 on demand videos that services the business model we're best known for and which is the foundation of our revenue model. Second, we've launched an ongoing series of 4 new workout plans each month called Body Blocks. Yeah, what the hell is a body block? These are new 3 week programs starting the first Monday of every month, serving beginners, general overall fitness, lifting, and specific plan each month for our connected bike subscribers. The body block plans are the incremental layer to appeal to the audience that's not project oriented, like our P90X customers, for example, but just looking for a cost efficient and effective alternative to joining a gym or hiring a personal trainer with the flexibility to take time off during the month. Our partners use that monthly cadence of new body blocks. Okay, our partners, Beachbody coaches, of new body blocks to start a new wave of subscribers every month rather than only when a new program is launched, which was the trend of our old model. Third, we've added positive mindset masterclasses to our platform, and it's a game changer for retention. This content makes Body the only platform offering complete fitness, nutrition, and mindset content in one subscription. So you see, when the coaches, the partners, one of the 4 vital behaviors is personal development. They can say, see how Body is helping you with your mindset. You just need to use Body for all of that. Everything is right there for you. We did this all for you with you in mind. These monthly masterclasses help people manage their mindset so they overcome obstacles and reduce their anxiety while they work to achieve their overall lifestyle objectives. You know, I'm really finding it a bit creepy that he keeps mentioning anxiety. So now you're taking people's mental health and you are trying to capitalize on that. That bothers me. Okay, this month, for instance, we're introducing a master class called Happiness Habits with bestselling author Petra Kolber. You see, gyms or other fitness services just expect members to navigate life's ups and downs and stay consistent. Just figure it out, which is unrealistic and obviously leads to high churn. You know what leads to high churn? Or MLMs, Carl. That's what leads to high churn. Because now you've really set this up that people will be churning more and more and more as you like drop people from coach, partner, whatever to preferred customer. It's a very high churn rate. That's what is a churn. Our mindset masterclasses give people the tools to start with a positive mindset that enhances their experiences and improves their self esteem, as we saw for those 2 feel good launches last year. When people feel good physically and are feeling good about themselves, that content has incredibly high value to subscribers and they're less likely to churn. Okay, fourth, we're also expanding the positioning of Shakeology to not only be the first superfood nutrition shake, but also the world's first superfood dessert, a smart dessert, if you will, with hundreds of recipes that take advantage of the incredible flavor variety of the Shakeology product line. The product is delicious alternative to traditional desserts. It has incredible health benefits. Healthy desserts fit perfectly into the health esteemed category and represent a massive new $48 billion market opportunity for body. There are tens of millions of people who may not be ready to start one of our fitness or eating plans, but who will absolutely take the first logical step of swapping their normal dessert for a superfood dessert that actually helps them lose weight and makes them feel great. And finally, all of this is driven by the powerful catalyst of changing the name of the platform from Beachbody to Body, demonstrating our commitment to our new network who feels strongly that the Beachbody name was poorly aligned with our mission and holding them back from expanding their market. I can confidently add that our body partners are extremely enthusiastic about these initiatives, including the name change, the simplicity, the price points, and especially addition of positive mindset content to the platform. Yeah, they're going to be happy about the positive mindset because you've been feeding that crap to them for how many years now? They'll be like, oh, look, our company is so cutting edge. We have mindset content too. Look at us go. Woo woo. And let's be real. Who is looking for a superfood dessert? Now, Shakeology, if you do a monthly retail price of Shakeology, is roughly $129. So you're telling me that people would be willing to pay that so they can have a healthy dessert. And thank you. Joe says super dessert, apples, pears. And Mommy Chan says, I hear the words mindset and want to run a mile. Think back. Think I'll stick to my Xanax. I think you are better off with your Xanax. Hey, Sam, how are you doing? DC tried one of their desserts and had to spit it out before she was sick. Wow. Doesn't To Be Mindset focus on mindset now? They have another program that focuses on mindset. Yeah, To Be Mindset was all about mindset. So I guess now they're just really pushing that more and more and more. And I'm wondering if they're doing other things, if like maybe the super trainers are coming on talking about mindset. Are they making book recommendations in there? I don't know. But I do know that there's always book recommendations, and I really think they're going to be like, oh, I have a recommendation for my team this month for mindset. It is in body. We can all go there and do it together. I don't know why I'm using that voice, but that's just what comes to my mind as a former Beachbody coach. So yeah, they're all, and you know what? Do I really think people were like jazzed about the name change? I don't think so. When you have to rebrand, it's usually because there's a problem. It's not because like, you know, it's just not aligned correctly. Maybe it never was aligned at all, you know? And maybe Beachbody has gotten such a poor name that you're like, yeah, we need to distance ourselves from that. They're engaged and have been promoting aggressively since the March 2nd launch. There are also some other important operational improvements we look forward to in 2023, such as simplifying our digital experience by reducing clicks at checkout and adding alternative payment options later this year, such as PayPal and Apple Pay. Okay, and I'm also thinking about these, promoting all this aggressively and simplifying it. Meanwhile, we have seen that the recognition, the ranking up for people has dropped dramatically. But you see it as like, oh my gosh, there's such great opportunity out there. Well, we haven't seen it pay off, have we? We've only seen it reduce. These are all powerful changes that are enhancing the productivity of our proven business model. I thought your legacy model was not, good anymore, but now you have a proven business model, a model which has been consistently successful whenever we innovate our approach to fitness and nutrition based on our observations within our ecosystem. I'm extremely grateful to the teams who believe so passionately in this mission that they delivered on this initiative on an incredibly tight timeline and budget. But our mission is clear. I love that tight timeline and budget. I bet their budget was tight considering everything has dropped. And they're on board. We're determined to help as many people as possible to achieve their goals and lead healthy, fulfilling lives, generating long term, sustainable, profitable growth and shareholder value. Meanwhile, stocks plummet. We know we're executing all this in an unpredictable environment, but that's exactly when there's the most room and demand for radical transformation, and Body is taking the lead. We never stand still. Now, let me turn it over to our CFO, Mark Sudan, with the details of the quarter and the full 2022 results. Mark Sudan. Thanks, Carl, and good afternoon, everyone. We are pleased with our fourth quarter results, which came in at the high end of our expectations. Fourth quarter revenue exceeded the midpoint of our guidance. Adjusted EBITDA was $3.5 million compared to a loss of $26.6 million in the prior year period. Notably, our fourth quarter results are a substantial improvement towards attaining a goal of generating profitable adjusted EBITDA on a recurring quarterly basis by the end of 2023. The actions that we implemented in 2022, coupled with our new Healthless team initiatives, Healthless, okay, set the stage for sustainable revenue growth. On our third quarter call, we discussed our strategic initiatives related to pricing, nutrition, and cost reduction. Let me give an update on these three initiatives, and let me take a sip of some water so I can continue. With regards to pricing and building on what Carl just shared, we introduced new Body pricing in September 2022. We adjusted Body Premium app to $179 annually from $298. And as of this month, you can only subscribe or renew on the Body Premium app. As a reminder, so actually it kind of went down from where it was. Okay, one clap for you for making it cheaper, but that's still pricey. As a reminder, the majority of our existing subscribers are involved only the basic library of all our programs at $120. Since we launched the new Body pricing in September, our Body subscriber file size has been growing in a healthy way. So while our overall digital subscriber base in quarter four contracted Body is growing, additionally, we are finding that Body subscribers have a much higher nutritional attach rate. Now, I'm thinking what they did was people who are partners, coaches, whatever, they went from just Beachbody on demand to Body. Do I think the general public is going, I just got to sign up for this Body? No, I don't. Do you guys think that the general public is going, I just can't wait to sign up for Body? Please let me know in the chat. I would appreciate that. So while sorry, got a text message. Okay, where was I now? These measures validate our vision of creating a higher value customer that is more engaged across our entire platform, including fitness, nutrition, and mindset. Say it with me, guys. Mindset. Helpless or helpless. Well, that was good. Wonder which family member was short selling. Don't know. They did rename the coach title. They're now partners instead of coaches. We expect that the customer lifetime value will be higher because first, we will generate a higher initial ARPU due to pricing. Okay, what the hell is ARPU? I'll look it up and I'll tell you, and then I'll flatly forget. But, that's just how we roll with this. Average revenue per user. Okay. That's what it is. Annual revenue per user. due to pricing. Second, we will experience lower churn given the higher engagement enabled by the new fitness and mindset programming. That is, if people can actually rank up and stuff, and if people who are coaches, partners, start seeing like, oh, I could actually make money with this, or they realize, gee, I really can't. I mean, it's all kind of dependent on that, Carl. And you're still going to be churning people in at the entry level. And third, we expect that body customers will have higher nutritional subscription attach rates. Moving to nutrition, we expect to realize margin benefits as we continue to shift our product mix to higher gross margin products and enhance inventory management. This leads to reduced excess write-offs and lowers working capital requirements. Our largest and most important nutrition strategic initiative is the extension of our high gross margin product Shakeology into superfood healthy dessert alternative. Okay, so now they're really going to be marketing Shakeology as a superfood healthy dessert alternative. So I'm wondering, so I thought it was supposed to be something to kind of like, a meal replacement. That's how it's been used in the past. And there's been, comparisons to like, well, you go to Starbucks and you spend $5 on a coffee there. You could actually be doing something healthy for yourself and drinking some Shakeology. So now are they going to tell people like, well, have your Shakeology in the morning to, replace your breakfast, but later in the day, girl, you want some dessert, have a second helping of Shakeology. Is that what we're going to do? I'm really kind of wondering, because it seems kind of like that's what they're going to like suggest. As you know, you want some dessert, you need some more Shakeology in your life, and you really don't. Please, you don't. Okay. This product extension will increase Shakeology's proportion of our product mix and accelerate long-term nutrition revenue growth. To be clear, this is not a new product, meaning there are no additional product development costs, simply put. This expands the existent, I forgot what TAM stood for, and is complemented with hundreds of recipes on body to prepare gourmet superfood desserts. We are still early in the process of monetizing this opportunity. We just started to train our network of partners, coaches, and we will improve. Okay, I thought that you didn't need to spend any time anymore on training anybody. You don't need to train your partners, your coaches, your downline. But they're talking about training them and will improve our online presence in terms of search engine optimization and media creative assets. Well, that's interesting. Okay, how are they going to, and I don't know, how are they going to improve search engine optimization, which so much stuff comes up for Beachbody? Are they going to try to do something so that body replaces Beachbody and search engine optimization? Are they going to really be able to distance themselves from the fact that they still are Beachbody? I really don't know. Okay. As a first step, our website now positions it very well. When you enter our app, you see fitness, nutrition, and mindset all at the top. This will generate more traffic towards those seeking nutrition engagement. What the hell is nutrition engagement? As it relates to our cost structure, we are continuing to gain efficiencies through our simplification initiatives. You know what the best simplification is just go away. No one needs you. We have right-sided our cost structure to the current run rate size of the business. As a result, we have reduced our headcount by over 40% to 615 employees since January 2022. So they've had massive layoffs to help them out because they were struggling financially. That's what I'm reading into that. Let me walk through some of our key initiatives and where they stand. We reduced our per episode cost of production by more than 50%. We completed the first phase of migrating our ERP servers to the cloud. Our SKU rationalization efforts are on track. Marketing continues to focus spend on variable commission partners or strict customers acquisition costs for quick payback. And we completed a restructuring this past January, resulting in a further reduction in force. Okay, this whole variable commission partners. So that's really, in the compensation plan. We will continue to capture additional cost savings through disciplined cost management, best practice, and process improvements. Our lower spend can also be evidenced by our year over year reduction in payables, accrued expenses, and lower capital expenditures. In our 2022 CapEx was 46 million versus 109 million in 2021, representing a 58% reduction. Well, you kind of have to reduce everything when your revenue isn't growing. Um, our CapEx declined dramatically as we consolidated to one technology platform and one production library due to our simplification initiatives. We expect our CapEx will continue at the same level in 2023 as it did in 2022. Turning to our results for the fourth quarter, total revenue was 148 million, which was 2% higher than the midpoint of our guidance. Digital revenue was 69 million, down 16% versus last year. Oh, that's the first time you've mentioned anything down. Digital subscriptions were 1.95 million at the end of the quarter, declining 23% year over year. DAU and MAU, what the hell is that? DAU and MAU. I don't know. Do you guys know what that is? Because I don't, and I'm looking it up. And after I do, I will promptly forget again. Okay, that is, what is it? Daily active users and monthly active users. Okay, that helps. Was in line with prior year levels at 29%, while retention improved year over year by 30 basis points to 96.8%. Nutrition revenue was 75 million, down 23% year over year. While we were disappointed with this contraction, this contraction, the actions that we recently implemented, including our focus on superfood, healthy dessert, new packaging sizes, and offering simplification, should improve our nutritional business in 2023. Connected fitness revenue was 5 million, with approximately 3,700 bikes delivered. Our $50 a month bundle for a bike with the body subscription continues to be our most popular bike SKU. While it is a great connected fitness deal, we still need to create more awareness of this offering. Oh my goodness. So yeah, I guess they're going to hope that new coaches get these dang bikes. Starting this month, as more users transition to the Body app, those subscribers will view the bike workout options, making it easier to market this offering to them. Gross margin was 57% of revenue for the fourth quarter, compared to 45% last year. The gross margin improvement was largely driven by revenue mix, which shifted to less connected fitness revenue in 2022. Let me walk through the gross margin drivers by key product line. Digital gross margin was 77% for this quarter, compared to 84% in the year prior period. The decline was primarily related to a smaller subscriber file size. As we regain scale, the production costs will be spread over a larger revenue base, resulting in higher gross margin. Nutrition gross margin was 50% in the fourth quarter of both 2022 and 2021. Now, I remember when those bikes came out, I don't know if they're still having problems with this, but they were having big time problems getting those delivered to people. So I wonder if there's a run on all of this. Will that like cause more people to be waiting forever for a dang bike if they start selling them fast, or if they come up with some kind of, I don't know, other kind of special to get people to purchase the bikes, because you can get a bike through some kind of not a credit card, but some kind of a finance solution type thing. We are aggressively managing inventory to forecast, which should reduce our exposure to excess write-offs in 2023. With a focus on Shakeology via healthy dessert and the Shake and Hustle packaging, our nutrition gross margin should improve over time. The connected fitness gross margin continues to be negative, with some one-time charges flowing through this fourth quarter. So the connected fitness, that is the bike. We are leveraging our bike studio bundle to drive bike sales without competing in price wars. This ensures that the LTV of the customer remains positive. Don't know what LTV is. Well, let's look it up and let me forget it promptly. You notice a theme here? I look it up, I forget it. Because there's just too many acronyms being used. Loan to value. Okay. Loan to value. There. Got it. This ensures that the loan to value of the customer remains positive. Importantly, our data shows that bike customers are very engaged in workouts and have a much lower churn rate. Total quarter four operating expenses, including impairment charges, was $114 million, declining 32% year over year, reflecting our aggressive cost management and 40% reduction in headcount from January 1st, 2022 to now. Selling and marketing as a percentage of revenue decreased by 11 percentage points from 63% to 52% of revenue for the year. Our selling and marketing costs are primarily driven by partner commissions and bonuses, which are purely variable. So that's all the bonuses that the coaches receive. They earn these funds based on transactions that they generate, which is related to recruiting people. So when you say transactions, you make it sound like, if they sell a lot of stuff. No, it's if they recruit the hell out of people. As for our marketing spend on media, we continue to be very disciplined in managing customer acquisition cost. So it delivers a profitable loan to market value. Oh, look, I remembered one. To CAC ratio. What the hell is CAC? Jesus Christ, all these damn acronyms. What am I going to do, guys? Look it up. Promptly forget it. CAC. Common access card? I don't think it's that. That's all. I bet you it's something with. Okay. And let me try something else and add another word. Customer acquisition cost. That's what it is. Customer acquisition cost. Okay. For quarter four, we reduce G&A. I'm not going to look that one up. Just don't feel like it. By 9% compared to last year, as we continue to manage expenses tightly. Also, in quarter four, we reduced our technology spend by 42% compared to last year. You can see our technology spend has been reduced significantly while simultaneously delivering a transformational change in our platform. We're putting everything under one roof and we're not spending any money on additional technology. That's what that means. This has been enabled by focusing our tech spend on one platform. All this contributed to materially improved adjusted EBITDA, which I looked up once and I'm not again, of $3.5 million compared to a loss of $27 million in the fourth quarter of last year. Our new cost structure positions us to generate profitable adjusted EBITDA on a recurring basis before the end of the year. Our quarter four adjusted EBITDA was positive as we intentionally settled our executive annual performance bonuses in equity. Okay, so their performance bonuses, do you think that they are getting any like stocks as part of their, bonus? I bet you they are. And those stocks are not worth shit. Excluding this equity comp add back, adjusted EBITDA would have been a loss of $2 million, which would have exceeded our guidance range of a loss of minus $9 million to minus $14 million and representing 93% improvement over the over the prior year quarter, if I can read and talk at the same time. Goodness. With respect to the balance sheet, we ended the quarter with an unrestricted cash balance of $80 million and $41 million of net debt. As previously mentioned, we do not see the need to raise additional capital. The existing debt arrangement has an additional facility of $25 million, which we do not plan on utilizing. Operating cash flow improved by $168 million year over year to negative $47 million, representing a 78% improvement. Fixed asset CapEx for 2022 was $26 million compared to $78 million in the prior year, representing a 66% improvement. Net inventory decreased by 20% to $54 million from the prior quarter and has declined by more than 59% since the fourth quarter of 2021. Our discipline of aligning our nutritional demand forecast with our supply side purchases resulted in both a lower inventory level and less exposure to excess write-offs. And also, less people have been interested in any of this nonsense. Overall, that's the kind of the picture that I'm seeing, is that less people have been interested. You don't own a bike, but you have heard Peloton. Jeanette, that's exactly what I've heard, is that the Peloton is much better. I would suggest if you want to do any kind of biking, anything, get a Peloton. And yeah, there was a problem with the bike. I'm just wondering if that's going to come back and bite them in the butt again. Yep, we should have taken accounting because, yep, I'm sure you guys are with me. I'm reading these acronyms. I'm like, I don't know what that means. But one of the things I think we can completely see is there has been a substantial drop overall of everything. Okay. All right, now I'm going to start here. Now I'd like to take a moment to discuss our outlook for fiscal 2023 in the first quarter. With regards to revenue, we are guiding quarter one revenue to be the range of $135 million to $140 million. End of quarter one is at the end of March, right? The first quarter is typically our seasonally strongest period. However, quarter one revenues for 2023 will not follow our normal cadence, given that we just launched our new strategy and offering. We expect to generate sequential revenue growth throughout the year as our initiatives gain traction. What makes you think these initiatives will gain traction? So it sounds to me like they're expecting to see a drop in quarter one, but then there's kind of smoothing it over, saying, well, we may fall this quarter, and we usually don't. We usually do really well the first quarter, but throughout the rest of the year, yeah, we expect gains, which I'm just not buying. With regard to adjusted EB whatever, we're guiding to a loss of $3 million to $6 million for the first quarter. We expect adjusted, that acronym, to gradually build throughout the year. Again, it's like we're expecting something lower, but you know what? Over time, it's going to be better as we begin to fully leverage our cost-saving mid-year and see sequential revenue growth. We will incur lower overall costs and gain efficiencies under our new simplified one-brand operating model, especially because you have gotten rid of a lot of people who used to work full-time at corporate. So, okay. We remain on track to generate recurring and sustainable positive adjusted, that acronym that I'm not going to say again, on a quarterly basis by the end of fiscal year 23. Next, I will provide color relating to our digital subscriber base. As a reminder, the majority of our customers are subscribed to the basic Beachbody on-demand platform at $120. And those customers will transition to our $179 body platform. What makes you think that they are going to want to spend an additional, what, $50 on this subscription when their renewal comes up? What makes you think that? Why do you think they will just naturally, change that? Now, if someone is a coach, they probably will. So I guess they're banking on when people's subscriptions end for Beachbody On Demand and they are still a coach, if they are still a coach, then those people will get body because they need to be using the platform. It's all about using the platform, which means you got to sell it to those coaches that are being recruited. And everything we know revolves around recruitment. The new body customers will get significantly more value, and we have received no pushback from our partner network. I call bullshit on that. I bet you anything in private groups, people are pissed off at having to pay more and pissed off that they can't just get basic Beachbody On Demand and they are being forced into this other thing. I would not be happy with that. If I was happy with Beachbody On Demand, why would I want to be paying more for something? Why? I wouldn't. So I'm just calling them out on that. I think that's a bunch of hooey. Since adjusting the price in September and before launching our revamped body platform, the subscriber file size grew and retention improved. I bet you it grew only because coaches had to renew at that time and they stayed because they're coaches. I'm sorry, body partners, whatever. However, our internal forecast has prudently factored a higher level of churn from Beachbody On Demand to Body due to the price increase. Well, good. At least you're thinking like there's going to be a high churn rate. There should be. Although we expect subscription declines for the year, I cannot stress enough that we are focused on attracting higher value customers with a higher ARPU. What the hell is ARPU? Good gravy. Is it just me? And I don't know if I looked this up earlier or not, but I'm looking it up right now. Average revenue per user. Okay. And believe that our Health Esteem platform on Body will drive stronger consumer engagement and improve customer retention over time. We will continue to manage the business for existing capital and do not see a need for a capital raise. To conclude, I would like to reemphasize the following. We have dramatically simplified the business and are delivering on our one brand strategy, resulting in significant cost reductions in a clear path to sustainable profitability in 2023. We just deployed our new Health Esteem platform, creating the only holistic fitness, nutrition, and mindset platform. We are excited by the preliminary results, and this is the foundation to bring us back to revenue growth. With that, operator, please open it up for questions. Oh, and there are questions. There's a question and answer session. Wow. I don't know if I want to go through all of this. Let me know if you guys want to look through this. How long is that? It's not that long. You can look at it. Let me know in chat if you would like to look at what questions were asked. I'm kind of interested in that. Okay. I want this to go away. Go away. Okay. So let me know your thoughts. You liked a Beachbody On Demand, don't care for Body, seldom use it. See, and that's the thing, And Jeanette says, yep, so many people are leaving due to the price increase. That's the thing. Joe says, jack up the price by $50. Sure, the real customers will say bye. Exactly. They're going to be like, forget about it and find something else. I mean, I don't care that the price used to be like close to $300 for all that. If you're going 120 to 179, it's like peace out. That is a substantial increase. You want to see the questions? Okay, let's check those out. Okay, so let me click there and let me get some water. Operator, thank you. Our first question. Oh, good Lord. I want this thing to go away. I thought it went away earlier. Our first question is from the line of Joanna Zoe with Bank of America. Please go ahead. Had to take a sip of my refreshing water. Joanna, hey, thanks for taking my question. Thank you so much for the overview on the rebranding and congrats on that. My question is just to help everybody to flesh it out a little bit more. Just trying to understand what percentage of today's digital subscribers are actually on Body already. And also, as you foresee people either renew the subscription onto Body from the status quo or prior program, how do you foresee the ASP will play out for digital subscribers? I don't know what ASP is. Good gravy. ASP meaning average selling price. Thank you. Good Lord. Oh, wait, where am I? Okay, I'm over here. Why did it go back to that? Do you guys see the questions? Oh, I don't think you guys see the questions. I'm so sorry. I thought you were seeing the questions that I was reading. I'm so sorry. I don't think you were. Okay. I think this is this it? Yeah, there you go. Sorry about that, guys. My bad. It happens. Okay. Okay. But also on nutrition subscription as well as connected fitness, because I understand that you're trying to integrate all three components into one so that people can get access to nutrition through your superfood, super world dessert, but also the bike as well. So just trying to really better understand how that really will impact the driver from revenue side, if that makes sense. And then I have a follow-up. Great. This is Mark answering. Great. Hi, Joanna. This is Mark. Thanks for the question. What I would say is that Body subscriber file size, if you recall, this started in the fall of 21 when we launched it. And it's basically our library. And at that time, we had live streaming. Right now, there are 8,500 live streaming workouts plus the 120 programs. And with what we just launched last week, we now also have the Body Block, the new fitness programming, plus the mindset programming and the revamp on nutrition. So going back to September, that's when we adjusted the price down for Body from $298 to $179. And that's when the file size, frankly, started growing in a very healthy way. So the reaction has been very positive. We're pretty happy with the way it's growing. Now, if memory serves, Beachbody on Demand came out at the beginning of, I want to say, 2018. And so it makes sense that, like in September and during this time frame of people who had subscriptions of Beachbody on Demand, that they would need to renew. You know what I mean? So yeah, you would see an increase, but is that increase going to remain month after month after month? Or is it going to go shrinky dink? And I think it's going to go shrinky dink. So even though I would say the majority of our customers today are still on BOD, Body has grown in a very healthy way, and we're pretty happy with how it's tracking. And the ASP, as you ask, the average, let's say the ARPU, whatever the hell that is, or that metric at a minimum annually would be $179. Some people may be signing up to quarterly, which is $99, right? So it only makes the ARPU higher in a smaller period. Retention has been tracking better, as well as engagement. All the good signs we want to see for the new offering like that. And finally, what I would say is not only are we more engaged, more likely to renew, but we're also seeing a higher attach rate of subscription. So our vision of deploying, of attracting customers that are higher value in net seems to be really working out well with all the pilots we did and since launching on March 6th. So that sounds like, okay, this whole idea of higher value customers, people willing to spend more money. So Joanna then says, okay, got it. Thank you. And is there a way to help us understand the renewal rate from the existing subscribers and switching to Body? If you can help us to think through that, that would be helpful. And then my other question is really on margin. I know you presented a few weeks ago and you provided the margin on 3 different segments: digital as well as nutrition and connected fitness. Digital, I recall you mentioned it towards 80%. Nutrition is hopefully getting back to 60%, and connected fitness close to break even. Can you help us understand in terms of the timeline, what is sort of realistic or likely timeline for you to achieve these targets by? So it will help us to model that. Thank you. Okay. Did this go to the next page for you guys? I don't think it did. Oh, wait, maybe it did. Okay, I think it did. And now I've got to close out this stupid thing again. Hang on a second. Okay, so Mark responds. Okay, go away because I don't like you. Yes, Joanna, let me start off with you asked about the renewal rate. So when we first increased BOD in last July from 99 to 120, I didn't realize it had gone up to 120. It was an experiment to see how would the renewal rate be impacted. We didn't see much of a negative impact, but it was pretty good. Well, I mean, that's not much of a price hike, but now you're adding an additional $50 to it. Now we're obviously monitoring very close Beachbody On Demand to Body. Now, superficially, this may seem like a pretty big price increase. Well, it is, but I'll say the biggest starts are actually people who sign up to what we call a total solution pack. So they're talking about new people signing up. And the average total solution pack, which is basically the combination of digital and nutrition subscription, was $180, and now it's $220, right? Well, I mean, you could get just a program. There were challenge packs that were like $150. So if they're talking about if it was like Beachbody On Demand and the nutrition, I mean, I think it was more like 150 back in 2017 when I was doing it. I could be totally wrong. I'm totally not remembering correctly. So I would say we haven't seen any pushback at all on the price. Now, to be more prudent, that's why we're not giving full year guidance, because a lot of change we've deployed. To be more prudent in our internal forecast, we factored in a lower renewal rate. But in general, I would say the jump is not as big on everybody as it may seem from the get-go. And then you asked about the margin across our 3 areas. So we're not giving specifics there. But here's what I would say. Digital right now is in the high 70s. We brought down our per episode cost by 50%. So I really think at this point it's a question of scale. So as soon as it starts picking up in size, and I'm talking more on the revenue size, you'd be amortizing the production cost over a bigger base. And that should bring back the digital margin into the low to mid 80s. On the nutrition side, look, it used to be at one point mid 60s. It went down to low 50s. Right now, it's around mid 50s. Our aim is to slowly work its way up. As you know, we've done a lot of things to improve our supply chain, like closing West Coast warehouse. We're aggressively managing inventory. As you can tell, it's down by more than half for the year. But most importantly, the product mix, by pushing more Shakeology and reducing low margin products, that'll be the biggest beneficiary to the nutrition margin to get it closer to 60%. And then look on the bikes. As you know, the bike's in the same game, lifetime value of that customer. So we're not going to aim to be profitable from the first sale on the bike. Our aim is to attract customers at a point where they're not losing too much money up front, but gaining a customer. As our data shows, that they're the most committed customer in terms of workouts and renewals, so that the lifetime value of that relationship is really healthy and positive. Joanna, got it. Okay, that's super helpful. My last question is just to clarify for anybody who get on this new brand of body, is it optional to do the nutrition super world dessert? I love how she calls it super world. And also, is it optional to get on the bike or all of that? Is it part of the sort of your program that people get on the body will have access to also, which means we'll need to see an uplift on nutrition subscriptions as well as the connected fitness units delivered? Carl, certainly that's the expectation. There's a few levers there. This is Carl, by the way. Good to hear from you again. First off, you're right. We've consolidated fitness, the eating plans, and the positive mindset content into this one subscription, which comes down to about $15 a month. And you can imagine, based on the number of apps out there, you'd have to have 3 or 4 apps to equate to what we're putting into this one synthesized offering. But what's beautiful about this is for the first time now, the bulk of our subscribers have visibility to the biking content. They couldn't see it before because it was locked behind a different paywall. So now again, the important strategy about connected fitness was selling it into the database. So they're thinking like, oh, people can see the bike workouts. And because they can see the bike workouts, they're going to be like, oh, I've just got to get me one of those bikes because I'm so committed to my fitness and to body. I just got to get me that. Let's sign right on up and spend a couple of $1,000s on these damn bikes. Sam, exactly. Most of the renewals are going to be from within. It's not going to be from external people. Excuse me. So sorry. Hang on. Sorry, though. Went down the wrong pipe. Oh, gosh. Hang on. Wow. And I feel like I'm losing my voice reading this stuff to you guys, too. Okay. Yeah, I totally took a sip of water, Joe, and it just like went down the wrong way. So sorry about that. Okay. Let me get back to where I am. Oh, goodness. So now that they've got visibility into their favorite super trainers doing these rides, we expect, excuse me, and have seen the demand for this new offering that Mark described, it will be incremental. And likewise, same thing with this concept of eat more dessert. That is superfood dessert. As an additional application to Shakeology, will give people within our own database who are not currently subscribed to Shakeology, excuse me, an additional reason to do it. I'm not going to be able to read anymore after this because I am absolutely losing my voice. An additional reason to do it, if you're, maybe it's coming back, if you're going to have a bowl of ice cream, you might as well have a bowl of Shakeology, nice cream, at a third of the calories. Higher protein, superfoods, fibers, all the good stuff for you and how to improve how you feel about your life. So all these things are incremental. And our focus is how we do attract more of what we call super consumers who are inclined to buy. That means attract more people to become partners, coaches, whatever, to spend more in the ecosystem as they're having a better experience. So overall, what I'm taking from this is that they're expecting the people who are partners, coaches, who have not seen the biking stuff to see it and go like, oh, I need to do that too and spend money. And since they now can have more dessert, Well, I need to have more than one Shakeology subscription each month. I need two so I can have Shakeology twice a day. You see what I'm going with that? It sounds like what they're really doing is marketing more crap to the partners, coaches, whatever the hell we want to call them. And our focus is how do we attract more of what we call, okay, I already said that. But at the same time, we do expect there will be people who just come in for fitness, who just come in for eating plans, who just come in for the superfood dessert, or just want to ride the bike and do our great rides. So, a la carte menu is available as well as everything under the sun menu. Joanna, got it. That's super helpful. It just basically helps to facilitate your upsell or cross sell the programs, but it isn't optional. Okay, very good. Thank you so much. Super helpful, Carl. Thank you. Operator. The next question comes from this person who I cannot, oh my gosh, with Credit Suisse. And Credit Suisse was just taken over by who? What bank just rescued it? Hang on. By UBS. Uh, let's see. Who took over Credit Suisse? UBS. And who was UBS? UBS today announced the takeover of Credit Suisse. So that's just funny to see somebody from Credit Suisse talking here. So this person from Credit Suisse, sorry, I cannot pronounce the name, and I'm not going to pretend to try to do it because I will completely screw it up. Hey guys, I guess good afternoon for you guys. Good evening for me. A couple of questions, maybe starting with the balance between a big new launch and controlling cost. And I guess I want to ask that in the context of EBITDA profitability this quarter. Great. But excuse me, but the guide for first quarter is a bit of a loss. So can you maybe just walk me through that balance between launching something new and managing costs, then layering on its highest amount of lost costs for quarter one, and that should sort of fade as we go through the year? Or am I thinking about it wrong? That's what it sounds like to me, Carl. Well, frankly, the launch costs are covered in the daily operating business. The cost to build this and prepare it really happened in 2022. We just launched it March 2nd. So now it's running the business, running it efficiently, and acquiring customers efficiently into a strong LTV. So we don't have the kind of launch costs like we're putting out a movie. This isn't a hits business. This is a business model that we've seen very strong proof of concept, really, when we started testing it back in March, then again in June, another test in September, and again in November, that we've seen incremental benefits from this that led to the configuration, pricing, and launch structure that we've had today. So I don't think there's going to be necessary a change without giving guidance to quarters ahead. I don't think there's going to be a dramatic change. It's not like we're digesting a big CapEx or launch budget in quarter one. Mark, yes, and okay, so the Credit Suisse guy interrupts and says, okay, sorry, go ahead, Mark. Mark, yes, what I'll add is that its simplification of consolidating all of our platforms has delivered incredible results to us, right? So we've been able to revamp and relaunch and transform ourselves while dramatically cutting down costs. And that's all enabled by having one technology spend, one marketing budget, one production library. So this massive cost reduction was all done in a way where we're able to actually deliver more, not less, right? Which should be very beneficial. So our current cost structure is totally set up for this current run rate of the business. And then from here, by deploying all these changes, all the growth starts delivering the profits thereafter. Okay, this Credit Suisse guy. Okay, great. And I guess a follow up on that, are the costs now where they should be? Obviously, everything you just talked about on bringing down various technology spends and bringing down G&A, is this now the run rate, or is there still more to go? And maybe just make sure that it's clear. I think the difference between cost cutting and efficiency, I recognize you'll continue to focus on being efficient, but that's some of the big heavy lifting. Would you say that's complete now after 2022 and we get on with it, or is it still more to do? Mark. Yes, I would say it's largely complete, right? Why does he keep saying right? Reminds me of Michael Williams' aim and on passive. There's just a few things to flow through to get the benefits. I mean, the last reduction in force we did was in January. But for the most part, we're pretty close to realizing the benefits of all the cutting we've done and driving the efficiency we want. And you could see from our CapEx spend in 2022 and 2023, that's more likely to be the profile of our CapEx spend going forward. We had some one-time costs in Q1 to incur due to the reduction in force and the severance. But once we started exiting that, I'd say we've pretty much set up the business to be able to run at this size. And then all the changes we're making is all about driving new growth, and thus the leverage model will create profitability from there. Credit Suisse guy. Okay, great. Thank you. Operator. Thank you. Our next question comes from the line of Joanna Comp with Baird. Please go ahead. Oh, Jonathan. I'm sorry, not Joanna. Jonathan. Jonathan. Yes. Hi, good afternoon. Thank you. First question. I want to ask if you could be a little more specific. What's the year's in cash balance that you're targeting? And could you share a bit more insight just to the key performance metrics that you're including to the forecast? Mark. Yes, John. This is Mark. What I would say is, like I just said in that previous question, we have a bit more cost to incur in this quarter for one-time costs. And then afterwards, largely at this size, we've set up the business not to burn more cash. So our plans is we're trying to drive this in a way where we avoid going below our net debt balance and start generating positive cash flow from there. I think the most critical thing to watch out for in terms of KPI, given all the changes we've done, is going to be the digital revenue, right? Because we're shifting to this higher value customer. That line will be critical to see if we're netting out. And our plan is to net out more favorably on the revenue side, despite having a bit less subscribers. Jonathan. Okay, I guess I'm trying to understand more of the revenue assumptions you're making, given the very significant changes to the business model. And if you could share a little bit more insight on the last comment you just had, effectively raising the price of your core product by 50%, how you expect the subscriber base to play out, and if you have any specific test data to base that on. Mark. Yes, we have plenty of test data, John. What I'd start off by saying, that's why we did the July price increase on Body to test that out. And then when we brought in September the price of Body from $298 to $179, the reaction was very positive. We've surveyed our coaches and partner network extensively. They're incredibly supportive, and mainly because, remember, that's what I was saying earlier. When they bring in customers, they mainly start them off on what we call a total solution pack, which is both digital and nutrition subscription. On average, that's going up by $40, right? It's going up from an average of $180 to $220. And then it goes to the normal nutrition subscription. So all in, we don't think it's that big on most of our customers. Bullshit. I mean, people did not want to keep on paying with Shakeology. People drop off of Shakeology after that first month, just saying. But okay. It's still considered great value for everything they're getting, because when you take the $179 and that's $15 a month. I love how they keep saying that. So from all the research and pilots we've done, we haven't seen anything that worries us the other way around. We're seeing a lot more positive because those people are more engaged. Retention is looking healthier for the body cohort. The nutrition subscription attach rates looking healthier. So everything we had in our vision, we're seeing play out through all the pilots and tests we've done since our launch. Jonathan. Okay, 2 more questions for me. Just as you think about the timeline for renewal, the 2 million digital subscribers that you ended up with. Could you just share more insight? What time of year you expect the majority of those to renew, and how will you, at what point will you know the success rate of your switch, and how would you react if the results are any different than you're expecting? Oh, that's a good question. Mark, yes, so the majority of our annual subscription, which means they flow monthly through March of 24, there's a bit of skewing towards the first 6 months because some are monthly, some are quarterly, some on a 6 month plan, but the majority are on annual. So I say a bit skewed though, the first 6 months, but overall, we'll see that 112 come through every month, all the way through March 2024. 112 renewals? Is that what he's saying? That there will be 112 renewals every month? Is that what you guys took out of that? Or am I just, smoking crack over here? Just wondering. Oh, hey, Monhun, how are you doing? Ask Peloton how loyal their connected device customers will be. Beachbody jumped into connected devices way too late, at a time when gyms were reopening and people dropped $50 at-home subscriptions. Yep. So username says, my mom was in MLMs when they were a kid. I watch these videos now to understand her paranoia and abuse. Not right what she did, but it helps me understand her guilt. Yeah, I mean, there's things that I did when I was a Beachbody Hunbot that really make me uncomfortable thinking about them to this day. Absolutely. So Joe, you said, oh, we can call it. Okay, that was when I was not able to talk so well. And hang on, I got to turn back on my heating pad. It went off. How dare it go off? Because I need that for my back. Okay, where am I in this? And let me get a sip of water. Hopefully I don't, have it go down the wrong pipe again. Okay, so here comes Carl. One of the things I'll say, Jonathan, is that $179 does give us an advantage that we didn't have at the lower price point. And that is, and we're in the midst of testing customer acquisition now through our direct channels, meaning the coach, the partner network. We run that very cautiously because we're sensitive to the cash flow implications of buying subscribers that have too long of a paycheck. But the $179 gives us much more room to buy a customer and get return of capital within a year. So we've got room to run a higher LTV or a higher LTV per start on those new digital subscribers. And if anything goes sideways on us, we've been very conservative with the way we forecast the renewal rate. But if anything goes sideways on us, we have extra room in acquisition and intend to, frankly, this is where growth can come from, that we take that extra room in the margin of the $179 versus the $119 for customer acquisition. So we can shift our emphasis over on acquisition from renewal if anything goes sideways. So basically, sign up more partners, because that's really what they need to do, is sign up more people who will be convinced that they need to have 2 subscriptions of Shakeology, not one, because they're pushing this healthy dessert bullshit. But again, you balance all these factors, right? Because the thing we promise the market, me, the way I like to run the business is I like to run it free cash flow positive. So the first thing we need to assure is that we're running on a positive EBITDA as soon as possible. Then we start to make sure we're investing in growth, but not the other way around. So we're balancing these things, and we're not doing it in a conservative, rational way, given some of the other uncertain macro factors at play. Jonathan, understood. Just last one for me on the connected fitness business. It's obviously a drag on the income statement currently. So could you just share more specifics on the LTV and that you see for that customer? And how do we know that it's not a broader distraction on the business, just given the size where it is at today? Thanks for taking all the questions. Carl. Yes, John, thank you. Look on the Connected Fitness one. With this new bundle we've launched, it's $1,800 upfront, financed through buy now, pay later firm called The Firm. And so we get that majority of money up front. So cash flow wise, it's actually very beneficial for the company, not for the people buying it. Um, Honestly, I think it's the best deal out there you could get for connected bike. It does not take a lot of our attention at all. And then really, I think now that we've launched this new body platform and there's such more subscribers on body, they'll start seeing the bike workouts, right? But they just won't be able to use it. It makes it a lot easier for us to market this to our database so we could drive more demand. Okay, this thing needs to go away. Did I go? I feel like I went backwards. Okay, this is Mark again. Maybe not. Yes, the one thing I'll say, John, is that I'm very excited by this. You know, this company, like we continue to innovate and test and learn, test and learn. That's what we did to make P90X a success and Insanity a success and Shakeology a success. P90X became a success because of all of the infomercials and Tony Horton. That's what made it successful. And also, it was brand new at the time, you know. And now there's a lot more choices out there. And having that lever of the connected fitness, it's such a good customer and this rich volume of people in our database. Now that they're all having visibility to our biking content that just started on March 2nd. So I'm actually very excited by the prospect of the connected fitness business, but we're not doing it at a way that drags the business, to your point. It's not a distraction. It's just an area of creativity where now we get to bring our best skills to the table. And that is creating content and use cases so people who get on that bike are going to be getting results and having a great time as they do it. And I will say, when this thing launched March 2nd, and people actually was the Monday, March 6th, that they really started to use this new content, we absolutely saw a jump, a significant jump in engagement on both body platform and on the bike. So engagement is a good proof of demand. So I feel like we're in a very good position. And as Mark said, the consolidation of the business and subscriptions just made this a much more efficient business model that now our network of partners, we used to call them coaches, our partners have the ability to stay focused and they're not changing gears every 3 months. And they've got a simplified view on how a person comes in. We're helping them. How can you make $200 a month? How simple can that be? So, like we say here, simplicity is velocity. So now they're going to be billing this of like, oh, you need to make $200 a month. Yeah, just become a partner and you can totally do that, girl. And I think that we've seen, can't talk. And I think that's what we've just achieved here, the launch of March. You know, I don't care what he says. We all know it's not simple for anybody to make $200 a month. And how much money are people spending to make that $200? Because one bag of Shakeology is 99 bucks. Plus you're spending the $15.95 for your back office. Plus if you get like another bag of Shakeology, that's another 99. Plus if you are paying out that if you're like on a 3-month subscription of this or a 6-month subscription of the body, you're going to have another expense pop up. So I just don't feel like it's all that well, going to be received. Okay, so Jonathan's like, okay, thank you. Operator, thank you. Our next question comes from the line of John, whatever, with Guggenheim. Please go ahead. Hey, Carl, I wanted to start with you. Start with when you think you about getting the word out about the new brand positioning. So, what is the plan on that? And then, to the extent that the partners are going to do a lot of heavy lifting, so the coaches are going to be out there marketing all of this. Is there a prioritization, right, that in the first, I don't know, 6 months, we want them to focus on more on the conversion, right, and educating their existing base as opposed to prospecting or not, right? You do both at the same time. Carl, that's exactly right. Our focus is with our best customers, the current cohorts, aka the coaches, the partners. Those are their best customers. And that's where we leverage our social media following that between corporate and our ambassadors. Okay, who the hell are the ambassadors now? We got 20 million people following us, including our current subscribers. So our job is to make sure that we are surfacing the concepts, the value, the positive mindset content, the 2 eating plans, and all of this content, 4 new plans that drop every month to all the subscribers to maximize renewal and to maximize engagement and obviously, hopefully, results for those customers. Then that creates a referral engine. And that's where our partners are so powerful. So now that we don't have to train them on a new program every other month. Okay, but you're saying that you're dropping 4 new plans. Is this just eating plans, not actually workout plans? It's a bit confusing to me. And are you not going to be coming up with new workout plans each year? Has that like kind of been pushed aside because you're focusing on all this other stuff? So you don't want to spend the money to create new programs? I'm really a bit confused on that, Carl. But we've got this same, what we call the body block construct that we've got to market month after month after month with a new wave of plans dropping the first Monday of every month. Okay, that must be what is dropping every month are these body block things. But it's the same construct. We will create velocity. So you got these 2 layers, right? First, priority, maximize sell through into the current subscriber base so that they understand the value that they're getting. And second, leverage that great experience and referrals through the partner network for incremental subscriber ads at a guaranteed payout. And that's the business model that's we've been running really for the last 15 years, but now it's more simplified so that the partners can be more efficient. So here comes Mark. Yes. And John, this is Mark. Let me just add to that. On the rebranding part, when we add up our social media followers or super trainers followers or key coaches, doesn't he mean partners? It goes to well over 20 million. And then our emailing database is over 10 million. So our ability to inform people and turn it into an opportunity to tell them who we are now and where we're going is not something that requires marketing spend. We're able to do it via our existing mechanisms budgets. John, all right, then my follow-up would be, you talked about the nutrition attachment rate. I think in the past that was, I don't know, maybe in the mid-teens or something like that. Where do you think that goes to? And then what will happen to that? And I know there's a bundle here, so maybe it's hard to parse out a nutrition ARPU right now. But I think the nutrition ARPU right now, right in the past was quite high. Does the attachment rate go up and the ARPU go down a fair bit or no? Mark. Yes, John. Look, you're right. Historically, it was the very high teens. Right now, I mean, if you just take the numbers, it's around 10%, Mark. We're going to bring it back to where it was, and everything we're seeing, like I said earlier, body file size is growing well, and the nutrition attach rate is where we want it to be. And I say that is a favorable way. And the ARPU for nutrition is around, I want to say 100 to 110 a month on average for a subscription. And 2/3 of that business is subscription. 1/3 is one-offs and through CRM and other campaigns we do on other products or they want. Carl. Yes, and John, I would add, if I could add that our CRM activities are literally of my role, my top 4 priorities, CRM of selling nutritionals and practically this idea of expanding Shakeology into the healthy dessert category is one of my top 4 priorities. Another one of my top priorities is to maximize sell through our number one supplement, and that is our pre-workout Energize, which is in one of those like bundles now. So then you can not only have 2 subscriptions of Shakeology because you want that dessert and you need to drink it in the morning too, but now you need to take Energize before you work out. So you need to have that as a third thing that you're getting on as a subscription in addition to the body, in addition to the bike, which I happen to have twice a day. It's my morning coffee and it's my afternoon pick-me-up. And we're seeing that through the really gets traction through the entire database. We've got consultants who have been helping us install what we call CRM sequences that once you install them and you understand what a 5 or 6 email sequence, what that productivity and return on that sequence can be, install it and let it run. So somebody cancels or somebody lapses or pauses or changes flavor, like we've got a sequence that runs. It communicates with those people in a way that now becomes predictable, additional revenue, retention, or additional LTV. So this is a priority. And we traditionally see a decline in the nutrition files just from Q3 to Q4. The fact of the simplification of the business, like I said in my opening remarks, we've moved it from 190 different configurations that our prospects had to wait through to 5. And we've also added a new SKU with over 20 servings of Shakeology and 20 servings of Energize. This is being used in a couple of ways. One is holistic product for people so they can get both of these things and not have pantry loading, meaning they're not going to be at the end of the month still having burned through their product. Okay, coming to the last page and my voice. So the next shipment is layering on top of that. Now with just 20 servings, it's appropriate to their consumption, but is also taking in sampling opportunity. Okay, let me just say the sampling opportunity, what are you talking about? The sampling opportunity, there are no samples unless coaches buy them. They don't get them free. Now it's just 20 servings is appropriate to their consumption, but it's also a sampling opportunity. And we're seeing people who are taking what we call the shake and hustle, shake and hustle pack of these 2 products are then making a decision. Do they like that configuration or do they want to pick one or the other rather than cancel the one thing that they got? So these are all of the levers that we've been experimenting with in the back half of the year and going into the first quarter that give us great deal of confidence that not only is the business model healthy, but we're making improvements to increase attach rate, which increases LTV. Operator, that concludes the question and answer session. I would like to now pass the conference back to Carl Daikler for closing remarks. Carl, all right, thanks so much, and I appreciate everybody jumping on. I know we went over a little bit here, but at the end of the day, the most exciting thing to take away from this call, which I hope our stakeholders see, is that the hard part is behind us. The cost profile has been addressed. We've added this compelling layer of content and positioning to add appeal to like it's an entirely a creative market that the fitness and nutrition business hasn't been speaking to, and that the people are doing nothing. The category of health esteem is creating new demand in a market where the majority of the population is still looking for the resource to help them look and feel good without having to give up the lifestyle that they love to live. So we're very excited by what 2023 has in store for us. And we're going to execute the way you've seen us execute for 24 years. So I appreciate everybody's support to build the greatest resource for a healthy, active lifestyle in the world. This is no small undertaking, but the ultimate outcome is going to be powerful company and business and very rewarding for everybody involved. Thank you, everybody. Operator. That concludes the Beachbody Company's fourth quarter full year 2022 earnings call. I hope you enjoy the rest of your day. You may now disconnect your lines. Boom. So yeah, overall, I mean, they're trying to just retool, rebrand, and get people every month. Surely the coaches will get confused. I think the coaches, okay, a lot of coaches already get Shakeology and Energize. That's a very popular thing to do. And I think this new product pack kind of puts both of those in the forefront there that encourages people to have both of those subscriptions. However, with this added whole healthy dessert thing, to me, that's just more like you need to buy more Shakeology. Now, Shakeology was supposed to last you for the month. So this whole 20 servings, I'm wondering, have they reduced the amount of Shakeology you get? I'm not really sure. Not really sure on that at all. Okay, guys, well, this has gone on longer than what I was expecting, and my voice is definitely giving out on me. But I do want to say thank you for being here. I'm probably going to do something later this week sometime, possibly on the Peter Sir thing that I just stumbled across. And honestly, I don't even know how I came across it. I just did. It was just doing some searching and boom, there it was. I think I was looking for something in particular and all of a sudden I was like, holy crap. And then I went down a whole rabbit hole and then there ends up being a shit coin attached to all of this too. So that's a bit interesting to me as well. Well, thank you very much for everybody who participated in the chat. Thank you to my lurkers and thank you to the people who joined as replay. And as always, thank you very much to my mods. I appreciate you being here. I hope you have a wonderful rest of your evening. And I am going to take the Bubby Wumpkins out so that they can go potty. And I'm going to find something to relax to and get ready for tomorrow. So have a great one. And don't forget you're beautiful and I love you. And thank you, username, for saying that you love my videos. I appreciate that. Have a great rest of your evening. Until next time, good night, everyone.